On December 12, 1980, Apple Computer went public. Priced at $22 a share, the initial offering valued the company at $1.77 billion. By May 2026, Apple has reached a $4.54 trillion valuation, with its common stock trading near $310. Yet, despite this market capitalization, institutional analysts are closely examining the company's fundamentals and identifying specific structural headwinds. One institutional report has issued a direct sell rating, setting a $205 price target. This represents a 24.1% downside from the current share price. To understand this discrepancy, we have to conduct a bottom-up fundamental analysis of Apple's Q2 2026 data to determine if financial engineering is obscuring a lag in innovation. This analysis comes as Apple navigates a historic executive shift, marking the conclusion of the Tim Cook era. John Ternus is scheduled to assume the CEO role on September 1, 2026. Ternus inherits a dual challenge, managing a projected 35% increase in capital expenditures to build AI infrastructure, while localizing manufacturing to reduce geopolitical risk. Assessing this transition at the intersection of AI development and rising infrastructure costs requires a detailed examination of Apple's balance sheet. In Q2 2026, Apple reported a 151.92% return on equity. This ratio is calculated by dividing $112 billion in net income by $73.7 billion in total shareholders' equity. This performance is achieved through a leveraged capital structure, utilizing low-cost term debt with maturities laddered between 2026 and 2042. The balance sheet confirms this leverage. Apple holds $371.08 billion in total assets against a suppressed $106.49 billion equity base. The company uses its operating cash flow, which exceeded $28 billion in the March quarter, to fund the share repurchases that actively reduce this equity. These repurchases have reduced Apple's outstanding shares from 26.47 billion in 2012 to exactly 14.66 billion by March 2026. To maintain this structure, the board has authorized an additional $100 billion repurchase program. This high return on equity is the result of shrinking the denominator through buybacks, rather than a direct reflection of top-line operational growth. In addition to buybacks, Apple distributes cash via dividends. The board recently declared a 27-cent per share dividend payable in May 2026, a 4% increase over the prior period. Over the last 12 months, the total payout reached $1.04, resulting in a 0.40% dividend yield. While often discussed as a consistent payer, Apple actually suspended dividends for over a decade starting in the 1990s, only reinstating the program in 2012. Historically, shareholders relied on stock price momentum, specifically the rapid expansion in valuation multiples seen between 2020 and 2022. By May 2026, that growth has slowed. The stock trades near $310.92, as hardware sales increasingly depend on carrier promotions for support. With product momentum moderating, Apple's investment case currently rests on these aggressive cash return programs to maintain institutional support. This transition also impacts Apple's human capital. The workforce reached 166,000 employees in 2025, representing a stabilized growth rate of 1.22%. Current demographics show that female employees make up between 33 and 35% of this global workforce. Apple enforces one-to-one pay equity globally for identical roles. In Australia, for example, a raw 14% mean salary gap is narrowed to a 2.9% median gap when adjusted for job title and seniority. The remaining statistical difference is attributed to a promotion gap. While entry-level hiring is balanced, female representation declines as you move up the pipeline, reaching 29% in the C-suite. There is also a technical adoption risk. Survey data indicates that female technical workers are utilizing generative AI tools at lower rates than their male counterparts. Regarding broader sustainability, Apple's 2026 environmental report confirms that 30% of its product materials are now recycled. While Apple leads in baseline pay equity and sustainability, the internal AI adoption gap and executive promotion trends present challenges for the next technology cycle. Projections are modest. iPhone revenue should grow at a 2.4% rate through 2030 due to longer upgrade cycles. Apple responds with a 35% capital expenditure increase through 2027, dedicated to building artificial intelligence infrastructure. This includes active partnerships, such as integrating Google's Gemini models to power the next generation of Siri. Simultaneously, Apple is committing $400 million to the American Manufacturing Program to secure its supply chain. This program localizes the production of critical hardware, utilizing TDK for sensors and Cirrus Logic in New York for Face ID components. Apple is currently prioritizing AI integration and supply chain resilience over near-term free cash flow. When benchmarked against its primary U.S. peers, Apple appears behind Microsoft and Alphabet in the timeline of AI integration. Microsoft and Alphabet have already scaled and monetized foundational AI models, while Apple's integrated features are still in development. Global hardware competitors like Samsung and Lenovo have also moved faster, releasing devices with hardware-integrated generative AI. Apple's primary defense is its vertically integrated ecosystem and high brand loyalty, which continues to drive recurring services revenue. The question for institutional investors is whether this ecosystem loyalty can withstand competition from rivals who have integrated AI more aggressively. Apple's 2026 Worldwide Developers Conference, themed Coming Bright Up, represents a public test of this AI recovery strategy. John Ternus assumes leadership at a difficult moment, facing a declining market share in China and a period of high infrastructure spending. Despite these pressures, the company's underlying cash generation and balance sheet liquidity remain unmatched in the technology sector. Ternus must now demonstrate that Apple can drive a technological leap while managing its mature, heavily leveraged assets. Ultimately, Apple's $4.54 trillion valuation depends on whether its balance sheet can provide enough time for its product innovation to meet current market expectations.